All right, we are done with PE finally. Now we move on to price to book value. Price to book is the price divided by book value per share. So in all these multiples, the numerator is always the current stock price. It's only the denominator which is changing. Book value per share represents, on a per share basis, the investment that common shareholders have made in the company. So how do you come up with this? You simply take the total assets minus liabilities. If a company has issued preferred shares, then should you subtract the value of preferred shares? You should, because this definition is based on common shareholder. And this should be very obvious, because what is P representing? It is the price of common shares. So the denominator also should reflect common shares. If there are any other kinds of shares, you need to subtract that impact, just the way you subtract the value of liabilities. Okay, what are the various rationales for using price to book ratios? First, if you have a situation where EPS is negative, or if EPS is extremely small or zero, you have trouble, then you can't use PE. But you can still use price to book, because for any company that you would be interested in, the book value should be positive. Also, the book value per share is more stable than EPS. Even when EPS is volatile, the book value per share is not that volatile. More useful for valuing companies with liquid assets. So for a bank, for example, with mostly liquid assets, it makes sense to value based on book value. Can be used when a company is not a going concern. So book value can be used for coming up with the liquidation value of a firm. Differences in PB may relate to differences in long run returns. We saw a similar statement when we started talking about PE ratios, and you might also recall one of the anomalies that you studied at level 1, where studies have shown that companies with relatively low price to book ratios tend to perform well in the future. And in fact, in investment related literature, this ratio has received a lot of emphasis. When we talk about value investing, the essence of value investing is to invest in companies which have a low price, a low market price relative to book value. What are the drawbacks of using this method? Assets creating value, example, human capital, are not on the balance sheet. So in our world, where the importance of human capital is increasing, if you talk about IT related companies, you talk about consulting companies, clearly book value is not a good indication of the overall value of those firms. So it does not make sense to use price to book value to value a company like McKinsey, for example. It can be misleading when companies have different levels of assets. So we are going to talk about an example of Dell Computers, where Dell and its competitors are obviously in the same business, but Dell outsources a lot. So does it make sense to use book values to compare? Not always. Accounting effects, example R&D, can compromise book value. You've seen this in FRA. You might have different companies that have a different approach towards capitalizing versus expensing. So similar companies, but if the approach towards capitalizing and expensing is different, does that impact book value? It does. BV is generally not reflective of market value. So if the book value and market value are completely different, then that also compromises this method. All right, so this is just an excerpt from example 18, which emphasizes that differences in models can be reflected in terms of different price to book ratios. If you look at the price to book of Dell Computers, that ratio is 10. And when we look at the mean value for comparable PC companies, that is 5, and the median is 2.7. So purely, if you look at these numbers, does Dell appear to be overvalued or undervalued? Dell appears to be immensely overvalued because it has a very high ratio. I hope you recognize this, but In general, all else equal, a high ratio where the numerator is a price of some form, a high number means overvalued, low number would mean undervalued. So Dell appears to be very overvalued, but when you recognize the fact that Dell has a different business model where it has a just-in-time system, so it maintains low inventories, it outsources whatever activities it can. So clearly Dell would have low assets and therefore low book value and therefore a relatively high price to book. How do you determine book value per share? It's fairly straightforward. You have to first come up with the common shareholder equity and then divide by the number of common shares outstanding, because the price is on a per share basis, so the book value also has to be on a per share basis. How do you come up with shareholder equity or common equity? So you come up with shareholder equity and then also subtract any equity claims that are senior to common stock. So for example, preferred shares, any of those claims also need to be subtracted. So you are purely dealing with common equity. I'm not going to do example 19, but you can look at it if you have time. It is just a simple application of what we have talked about here. Many analysts make adjustments to reported book value. So we talked about the fact that the book value might not be totally indicative of market value. So there might be other reasons also for why an analyst just doesn't look at the balance sheet and use that book value. Some adjustments need to be made. Two major reasons are shown right here. To make the book value per share more accurately reflect the value of shareholders' investment. And number two, to make price to book more useful for making comparisons among different stocks. So if different companies are making different assumptions about capitalizing versus expensing, then obviously you have to make some adjustments before you compare. So what are some of those adjustments? A, you could exclude intangibles. Is it possible that one company has grown through acquisition and therefore has a large amount of goodwill? Another company has grown organically and therefore does not have goodwill. So the assets of the company that has grown through acquisition will be inflated because of high goodwill numbers. Would it make sense to remove all goodwill when comparing? It does. When you come up with a number after removing goodwill, that number is called the tangible book value. So more precisely, if you come up with book value looking only at tangible assets, then you have a tangible book value. Does this always make sense? Maybe, maybe not. For companies, manufacturing companies, it might make sense. If you are evaluating consulting companies, then it might be silly to use tangible book values alone. Adjustments necessary to enhance comparability, and you've seen a lot of this in FRA. So one company uses US GAAP and then inventory valuation is done using LIFO. Another company uses FIFO. So make the adjustment before comparing. Adjustments for off-balance sheet items. One company uses operating leases, the other uses financing leases. So you might want to make an adjustment there. And obviously fair value adjustments. If clearly land, property or property, plant, equipment is based on historical cost, which is way below current market value, then before comparing, you can make a reasonable fair value adjustment. If you have time, go over example 20, which talks about many of these adjustments. And if you are good with FRA, then this should be very straightforward. All right, now valuation based on forecasted fundamentals. So what does this mean? Just like you came up with a PE ratio based on fundamentals, similarly we can come up with a price to book based on fundamentals. Now, if you are the sort of person who just likes to memorize formulas, then this is the formula for price to book. It's not a very difficult formula. It's ROE minus G over R minus G. And in order to help you remember this, R minus G is similar to what you've seen before. Do you think a company has a high price to book if the ROE is high relative to growth? Answer is yes. So that's not a precise explanation, but it might help you remember. Those who want a precise explanation can look at this derivation. It is not required that you know this, but I think it's interesting. This, I hope you remember, PE is the retention ratio, 1 minus B over R minus G. Then, how do we go from here to here? If you notice that what we've done is instead of E1, we've written ROE into B0. What's ROE? ROE is simply net income over equity, which is book value, right? Or earnings over book value. So the book value would cancel out. So E1 can simply be written as ROE times book value. Then once you buy that, then what you can have is P over B, and ROE moves up here. So what you essentially have then based on this is P over B is equal to ROE into 1 minus B over R minus G, and then this can be written as ROE into 1 minus B times ROE, which is this. Okay, and what is ROE times B, which is the retention ratio? That is simply G. So like magic, we have P over B is equal to ROE minus G over R minus G. If you want, you can learn the derivation, but I would say that once you are convinced, just remember this relationship. All right, now just to make you do some quick work, use that relationship and come up with what the justified price to book should be for this firm. So this is a straightforward calculation, but again, I'll emphasize that obviously it is looking simple right now. You need to remember this because there's a fair chance that this might show up on the exam. All right. Now, PB using the comparables approach. The concept is similar to what we've talked about earlier with PE. You look at a set of comparables and then you look at whether the price to book for your target company is higher or lower than the price to book for the comparables. So I want you to do this. This is a relevant excerpt from example 21. So given the data below, is MER relatively overpriced or underpriced compared to the industry and then compared to peer companies? The first thing is compare with the industry. So you look at the price to book value of 1.5 for your target company compared to the industry. Does it appear overvalued or undervalued? So the price to book is low, so it appears to be undervalued relative to the industry. But then maybe it is undervalued because of differences in ROE. So it does have a slightly lower ROE, but if you really think about it, the price to book is substantially lower than the industry value of 2, but the ROE is only marginally lower. So we can say that based on this information, it appears that MER is relatively undervalued compared to the industry. What about compared to the peer companies? When you compare with the peer companies and just look at price to book, the price to book is in the same ballpark. Okay, it is a little bit higher than GS, but the same as MS, but roughly in the same ballpark. So then you look at the other numbers. The other two companies have a higher ROE and lower betas. So compared to these two other firms, MER looks overvalued. So notice what we are doing here. We are actually combining comparables with also looking at some fundamentals. And that's quite important. So just looking at the PB is not enough. You also need to look at other factors. Okay, this is the explanation from the curriculum. Moving on to price to sales. And I'd say this is relatively less important, but you still need to know this ratio. Certain types of privately held companies, including investment management companies and many types of companies in partnership form, have long been valued by a multiple of annual revenues. In recent decades, the ratio of price to sales has become well known as a valuation indicator for the equity of publicly traded companies as well. So It's an important ratio that you need to be aware of. What are the rationales for using price to sales? Sales are less subject to accounting manipulation than EPS or book value per share. Sales are positive even when EPS is negative. Sales are more stable than EPS. I'm not giving any explanation here because these items are fairly obvious. More useful in valuing mature, cyclical and zero income companies. And finally, differences in price to sales may relate to differences in long run returns. So all fairly straightforward. What are the drawbacks? Might have high sales growth but low earnings and CFO. This connects with FRA, like so many other things in this reading. You might have a company that is doing overly aggressive revenue recognition. Will the sales numbers be going up? Yes. And maybe earnings and CFO might not be going up. Price to sales does not capture difference in cost structures. This is blatantly obvious. You might have two companies where the sales are growing at the same rate, but one company has a high cost structure, the other has a low cost structure. So will that difference be captured in this ratio? It will not. Does not capture different capital structures. Again, that is obvious. And over here we say sales are less subject to accounting manipulation than EPS or book value, but can no manipulation happen? That's not true either. Different companies, as we've seen before, can have slightly different revenue recognition practices, and that obviously will impact sales. How do we calculate this number? It is obvious. Total sales divided by the number of common shares outstanding. And as I mentioned before, as an analyst, if you are using this ratio, you need to have a good understanding of the revenue recognition policies being used, especially if you are comparing different companies. Valuation based on fundamentals. This is the formula to remember, but where is it coming from? This, I hope, is familiar by now. So PE is simply, this is the trailing PE. The trailing PE, this is the payout ratio actually. So it's the payout ratio into 1 plus G over R minus G. Then what are we doing? If you move E naught over here, so the E naught comes here, and then divide both sides of the equation by sales. Then on the left you have price over sales, and on the right, what is this? Earnings over sales. This is the net profit margin. And knowing the CFA Institute, anytime you see the net profit margin or something like that, they might imply that either you just come up with this or they also have thrown in DuPont. So if you know all the other parts of DuPont, you can come up with net profit margin. But this is the formula. I think this is extremely straightforward, hence I'll not go over all these examples. If you have time, you should do so. In example 22, you see how to simply calculate the price over sales. Then 23, 24, 25 talks about revenue recognition practices, which could easily also be part of your FRA material. 26 talks about the justified PS based on forecasted fundamentals. You are given these fundamentals, you plug and play and come up with PS. And then PS based on the comparables approach. What do you think happens there? Is all else equal, is a high ratio good or low ratio good? As with all other ratios where P is in the numerator, a low ratio means that the stock is relatively undervalued. Price to cash flow. Price to cash flow is a widely reported valuation indicator. Because of the wide variety of cash flow concepts in use, the analyst should recognize the exact definition of cash flow that is the basis for the analysis. And what are the different definitions of cash flow? There are several, but some that we've looked at include CFO, FCFE, EBITDA. Some analysts simply take net income and quickly add the non-cash charge. What are the rationales? Less subject to manipulation relative to earnings. More stable generally than EPS because there is less room for assumptions and manipulation. Addresses the issue of accounting differences to some extent. differences in price to cash flow may relate to differences in long run returns. And this last bullet point you will see almost across the board, and I've already explained what this means. What are drawbacks? Earnings plus non-cash charges definition of cash flow ignores the changes in working capital. Okay, so it would be more appropriate to use FCFE, but here again there might be some assumptions that need to be made. And an issue with FCFE is that it tends to be more volatile, and often, at least for young companies, this might be negative. Valuation can be based on forecasted fundamentals and based on comparables. Comparables is obvious. What does valuation based on forecasted fundamentals mean in this context? Fortunately, we don't have a formula to remember here, unlike the earlier ratios, but the idea is straightforward, and I'll illustrate the idea through example 30. So you are a technology analyst. The idea with a justified P to cash flow, price to cash flow based on fundamentals, is that you can come up with the value of a company based on a cash flow measure such as FCFE. Is that easy to do? You've done that before. This is from the earlier reading. Then what is the justified PE based on fundamentals? That justified PE would simply be the value that you come up with through the use of fundamentals divided by divided by whatever measure of cash flow you are using. Since we are talking about price to cash flow, when we talk about the justified number, you don't use the market price, you use the value that is calculated based on the fundamentals. That is the fundamental point over here. So in this scenario, what is the intrinsic value? If you simply plug in the numbers, this is coming up based on a formula. Calculate a justified PE. How do you do that? You take the value, which is like the V0, divided by, what's this number? This is the measure of cash flow that we are using. So the measure of cash flow here is earnings plus non-cash charges, 5.43. So you simply do that. What is the justified price to FCFE based on forecasted fundamentals? That's shown over here. So all this example is doing is also illustrating that you can have different definitions of cash flow, and obviously depending on the definition you will get a different ratio. Okay, based on comparables, if you are given this information and you are asked which company is relatively overvalued or which company is relatively undervalued, what will you say? Alright, so if you think about which stock is more attractive, in terms of price to cash flow, A has a lower price to cash flow, so that is more attractive. When you look at price to FCFE, with company B we have a negative FCFE, so there again A is more attractive. In terms of growth rates, A has a higher growth rate, so it's more attractive, and the beta is the same. So when you look at this information, A seems better. And this is what the curriculum says, which you can also read. The final one for section 3, which is dividends. Price to dividends, which is obviously the price divided by dividends, and dividend yield. Keep in mind that dividend yield is used much more frequently than price to dividend. And you might think this is straightforward, but there are a few important items to keep in mind. First, let's talk about the rationales for using dividend yield. Dividend yield is a component of total return, and dividends are a less risky component of total return than capital appreciation. And these are the drawbacks. Dividend yield is only one component of total return. Not using all information related to expected returns is suboptimal. Investors may trade off future earnings growth to receive higher current dividends. In other words, if you as an investor demand high dividends, what are you compromising? You are compromising future growth. So holding returns on equity constant, dividends paid now displace earnings in all future periods. This is called displacement of earnings. The argument about the relative safety of dividends presupposes that market prices reflect in a biased way differences in the relative risk of the components of return. So that's considered a theoretical drawback. Okay, now you might think that calculating dividends is easy and calculating dividend yields is easy, but there are a few basic caveats. As with other ratios, you can have trailing numbers and leading numbers. Companies might pay dividends every quarter. They might pay dividends every 6 months. So let me emphasize what you need to do here. Trailing dividend yield is generally calculated by using the dividend rate divided by the current market per share. Okay. Then the question is, what's the dividend rate? The annualized amount of the most recent dividend is known as the dividend rate. So this is an important point. It's the annualized amount of the most recent dividend. For companies paying quarterly dividends, the dividend rate is calculated as 4 times the most recent quarterly per share dividend. So let's just look at example 32. If you look at company PG and you are sitting here, let's say in third quarter 2008, what's the dividend amount? 1.6. So the dividend amount will be 4 times the most recent number. So it is going to be 0.4 into 4, which is 1.6. But what about this other company, UL? And again, you are sitting over here. This other company pays dividends every 6 months. And it looks like there is a big difference between the dividend. So the intermediate dividend is a small number, and then the final dividend is the big number. So there are several scenarios here. Do you just take 0.668 and times 2? That would not make sense. What you actually do over here is add these two numbers. When a company pays only 2 dividends a year and there is a difference between the two, the convention is to simply sum up those two numbers. So here you will just take the sum of the two numbers as the dividend for the other company. Remember that. The leading dividend yield is calculated as the forecasted dividends per share over the next year divided by the current market price per share. Valuation based on fundamentals and comparables. So valuation based on fundamentals is straightforward. Hopefully you remember this. What is the price of a share? The price of a share is D naught into 1 plus G over R minus G. So then instead of D naught over here, you can have D naught over here. And then what are we looking at as the dividend yield? It's simply the reciprocal of this expression. So it is R minus G over 1 plus G. And then based on comparables, is a high dividend yield good or low dividend yield good? Actually, all else equal, now a high number is good because we are talking about a reciprocal. The price is in the denominator. Unlike all other ratios that we've talked about, the price has been in the numerator. Now we are talking about a yield, so the price is in the denominator. So all else equal, if you are two companies in the same industry, same growth prospects, same risk, then which one would you prefer? The one with the higher dividend yield or the lower dividend? All else equal, you would prefer a higher dividend per dollar of share price. So now based on the information presented, which stock do you prefer? Let's just look at the numbers. Consensus forecasted growth numbers. So who is looking good here? So if you pick the best two, it would be PPL and Pepco Holdings. Based on beta, who is looking the best? There you look at the low beta. Dividend yield, all else equal, you are looking at relatively high. So these are all roughly in the same ballpark. And then, so what is the payout ratio telling you? How much percentage of earnings are paid out? So with the dividend yield, here are the companies that seem relatively high. Now looking at these numbers, it is not obvious which one is most attractive. It really, in a sense, depends on you. If you look at PPL, from a growth forecast perspective, it is really attractive and the beta is relatively low. Dividend yield, as you might expect for a high growth company, is relatively low. So from this perspective, PPL seems attractive. If you are purely interested in high dividends, then this company, Progress, might appear appealing because it has the higher dividend rate, and the beta is also somewhere in between, so it's not overly risky compared to the peer companies. So bottom line is, it really depends on you over here. There is no obviously attractive company in this list.